All right, so I get this question a lot. Henry, how do I close a profitable position? How do I close an option position for a profit? How do I recover from a loss? How do I actually close a position? Well, you guys are in luck because almost nobody talks about this, but I'm gonna give you the foolproof formula for how to close an option position profitably, even if it is in the red. So this is gonna be completely life-changing. Make sure you take out some notes, pen, pencil, what have you. Smash that like button for Uncle Henry. Subscribe to the dopest option channel in the world. And all right, let's jump into it. So in the past month, I've actually done really well. And honestly, I don't have that many risky positions. So as you can see over here, this is my current positions. And if you'll notice, a lot of these positions are up, and that is because the market is up. But I would be up on these options anyways, whether the market is up, down, or sideways, because a lot of these positions are out of the money options. And that's how I recommend that you trade options. If you want to be profitable long term, you want to sell options that are out of the money. So if you'll notice, the first stock that I have right now is American Airlines. I've been doing this for a number of weeks. It's been like 3, 4, or 5 weeks in a row already where I have made money on American Airlines. And that's because American Airlines has very good support at the $13 level. Now, I'm selling put options, which means that if the stock falls, I get to buy shares. If the stock stays above 13, I don't buy shares and the premium is mine. But the premium is mine either way. The only difference is if American Airlines is below 13, I buy it. If it's above 13, I don't buy it. And if I don't buy it, then cool, I'll just do this all over again. If I do buy it, cool, I'll just sell some covered calls, okay? So this is a win-win strategy that I absolutely love, selling put options. Now, how do you actually close a put option? What happens if this put option goes into the red? Well, actually, here's the trick. If you look at my portfolio right now, this is ideally what's supposed to happen. All the positions are supposed to be up, and ideally, probably 9 out of 10 times for me, when I sell options, right, mostly put options, I'm typically selling put options or put credit spreads, which is what this Google position is right here. I basically sell one put option and then I buy another put option. And because one of them is more expensive, which is this 98, it's more expensive than this 95, I end up collecting a credit. I end up making some money because one thing is more expensive than the other. Now, for closing a position, I typically do not close. So this is one of the biggest myths. People think that you need to close an option to be profitable. You need to get in and get out. It's actually not true. When you sell an option, the best thing that can happen is absolutely nothing. You don't touch it, and you just let it expire worthless. Now, when it expires worthless, not only do you not have to pay a fee, you don't have to really do anything with it, it also makes you 100% of the option premium. If you close it, you have to pay $1 to $5 or even $10, right? Now, what do you do if this option is in the red? So for example, let me go down to one of my options, which is in the red, okay? The only one, well, it's actually in the green for Robinhood, but the only one that is at a loss currently is Apple. But this is the case where I'm still not going to touch it. I'm going to let it expire. Why? Because if I were to touch it right now, it would be pretty expensive. For example, let me click into Apple. So I have Apple for $152.50, but that's not that important. What is important is how much I currently have, which is 400 shares, their current stock price, which is $165.98, and then the option price, which is, the 150 strike, it's going for $18.10. Well, right now, if I were to buy it back, it's worth $18. So it would cost me $1,800 per contract. But if you notice, the 150 strike right here is actually only worth to me about $15.98. That's because 165.98 minus 150 is $15.98. So it wouldn't make sense for me to close this option because it's going to cost me $18. Whereas if I just wait, this option will just sell off for me. So by closing it early, it's actually costing me more money than the option is in the money. So the option is in the money by 16 bucks, but it cost me $18 to close it right now. So the best thing that I can do is actually just wait until September 16, and then my shares will be taken from me. That's because this is a covered call position. I have 400 shares, but I have sold 4 contracts of this option right here at 150, and that just means I'm going to lose my shares. But that's completely fine with me because I am actually going to make a gain on this position. Although it's showing me that it's going for a loss, I have sold put options to get in. I've sold call options many times, and this time, because the market ended up recovering, now I'm going to lose my shares. But in fact, my average cost is not really $152.50. That's because Robinhood and many platforms don't take your average cost down when you're selling options. You're selling options and collecting premium, but your brokerage is not accounting for it, which is why I recommend that you have an Excel sheet or a piece of paper where you track how much premium you're collecting when you're selling options. This is exactly how I track my profits in my Discord community. I doc and log every single trade that I make to make sure I know exactly how much money I've made on each stock and for each of my positions. Therefore, when selling options, the best thing to do is actually to do nothing. Now, I want to give you some more insights into my portfolio and how I'm going to close my other options. So for American Airlines, I'm obviously not going to touch that. For put credit spreads, I also like to not touch them. Now, I will tell you, when I do close a put credit spread or a call credit spread is when the stock ends up touching one of my strike prices. So for example, look at this position right here. I have Google 98 put that I have sold and a 95 put which I have bought. I'm up $93 on this position. There's no need for me to do anything with this position. I'm just gonna let it expire. However, if Google was not $118.91, and if it went down to $98 exactly, at that point, I would actually think about closing this position because the stock has touched one of my strike prices, which is the 98 strike price. So if Google stock went down to $98, I would then protect my profits, or actually I would protect from losing more money and losing the full amount of my collateral that I've put up, and I would just close this put credit spread position for a loss, a slight loss, or hopefully is just breaking even, because when I get into this position, obviously I'm collecting a credit. Here I'm collecting $31, and if this position ends up being at break even or slightly negative, at that point I'm going to cut the position, especially if it touches the 98 strike price. For the rest of these positions like Google, Meta, Neo, Shopify, all these stocks that I'm up, Airbnb, I'm going to let these positions expire. As you can see, it's 96% gain, 96% gain, 93% gain. Here is actually a Netflix call credit spread. So a call credit spread is a little bit different from the put credit spread. It's basically betting that a stock isn't really going to rise that much. Now for Netflix, I'm not that bearish on it, but I'm also not bullish. I'm pretty neutral. That's why I decided to sell a call credit spread. For closing a call credit spread, I don't really need to close it because it's out of the money still. Netflix is under $240 and I'm profiting on this position. However, very similar to what I said about Google, if Netflix were to go up in this case, because this is a call credit spread, see these are calls and these are puts. For the call credit spread, if it were to hit 240, my first strike, at that point, I would end up closing this position or looking to close this position very quickly. If Netflix goes past 240, let's say 241, I would protect my collateral and I would close this position, because if you close this position earlier and you don't wait until expiration, then this 245 call, which you're long, which you have bought, is going to be worth some money. And because it's worth some money, you can end up saving yourself a lot of money because you can sell the 245 for some premium, but obviously you have to buy back the 240, which is going to cost you some money. But in this case, you're going to protect yourself from losing the full collateral amount. So in this example, 240 and 245, it's going to be a $500 collateral. Well, if the stock goes to 240 or 241, you can usually end up closing this position for a $200, maybe a $250 loss. Guys, this is how option trading should look like. You should be very consistent. You shouldn't have big swings in your portfolio. You should have a consistent stream of income on a weekly or semi-monthly basis. It should be very clear and consistent, just like this. And as you guys can tell, I'm a very big proponent of selling options, not buying them, because when you're buying options, it's very similar to being in a casino. It's a very rough game. It's a very volatile game, and it's not a consistent game. For me, the biggest consistency, and from the research that I've done at Goldman Sachs, from the 2 hedge funds that I worked at, selling options is a far more consistent and passive way to make money trading and online than it is to buy options or swing trade. For swing trading, you need a high amount of technical analysis, and honestly, technical analysis doesn't always work. In many cases, the technical analysis that I've seen that is used on Wall Street has only worked a percentage of the time. And that's because if any one technical analysis method would work, then everyone would use it, and that method would be exploited. Just like fishermen exploit a pond of fish, there isn't going to be that many fish left if everyone exploits the same waters. Or if a truck fell with $100 bills everywhere, even if it was $1 billion on the side of the road, there would be a lot of cars that would stop, everyone would start picking up the money, and honestly, that probably wouldn't even last past an hour or two. Right now, the top 2 strategies that I'm using, I love to keep it very simple, very straightforward. Of course, there's some strategies where you can grow a small portfolio, like butterflies, like spreads. But for me, the most consistent strategy that I like is to keep it very simple by just selling put options, covered calls and running the wheel strategy. I have a video about the wheel strategy that you need to check out right here.